When you're looking at deals as a passive investor, you want to know what the reversion cap rate or exit cap rate,
Goddamn right.
or another term for it is here I have a table showing the terminal cap rate sensitivity analysis. And this is one of the major lens that we look at a deal. So let's take a look at this first one up here, the terminal cap rate. On the left side, now this is what you're underwriting the deal. With a lower cap rate, you're assuming that you're selling it within a stronger market. Obviously, you want to be conservative, assuming that you're going to be selling it into a much weaker market. So ideally, if you can push the numbers higher, in this case, 6.5%, you're showing you're stress testing the deal in a way. So let's take a look at the year of disposition, which is the exit year. Focus in on year 5. Assuming you're taking the entire business plan throughout, where does the numbers fall? And this is in terms of equity multiple. So a 2x equity multiple means you doubled your money or 100% return. And if you did it in 5 years, that would be 100% return in 5 years or approximately 20% a year. Let's say we assume that the market was worse in 5 years from now. Of course, we don't know what the market's going to be, but let's just say the cap rate increase to 6.5. Then that return would go down to a 1.68.
What a bummer, man.
Right now, we are in a high cap rate type of environment. Let's just say we're sitting at a 6% cap rate. And with interest rates coming down, 2-3 years of recovery, we may be in a situation where cap rates are at about 5%. You might be conservatively projecting 2x equity multiplier, but we could get lucky.
It's like $1 an hour.
Cap rate could go down to 5% and it could be a 2.43 or much more than doubling your money. I believe that's 150% return on your investment in year 5.
To give Chicago a Super Bowl champ. And we're not doing this because we're greedy. The Bears are doing it.
Now, the chart on the bottom here is based on a $100,000 investment, just to make math a little bit easier, just in case you get confused with equity multipliers. And sometimes I do it, especially when they go over 3x, 4x. I don't really know what that is off the top of my head. Sometimes I got to write it down. But this is just another way of showing it in dollars what that looks like. So again, that 5.75 cap rate in year 5, assuming the deal goes to plan, is $101,000 on your initial investment of $100,000. Of course, you get the $100,000 back as your principal.
What could possibly get worse than that?
Let's just say the cap rate slightly expanded from a 5.75 to 6. Then that same return would go down slightly to $89,000 there.
It could have been worse, John. A lot worse.
What I would do is take a look at this chart and go up and down the slider and get a feel of how important this number is. It's super important here, super important number. And it's one of the numbers that is very easily fudgeable from a general partner operator standpoint to pencil in the right numbers. And your job as an investor is to be an astute student of this. You're not necessarily going to understand how to put the profit and loss statement together, but you can spot check something as simple as what is the reversion cap rate in the deal in comparison to the prevailing cap rate that it is today. Now, we're at interesting times here in 2024 and beyond. Cap rates have greatly expanded to a point where we're in a relatively high cap rate period.
I'd be cautiously optimistic.
Let's just call it about a 6% cap rate. Of course, different markets, different asset classes, A, B, C class, there's different variances on this. But it wasn't too long ago, a couple years ago, that prices were 30% higher, meaning that the cap rates were probably in the low 5s. And what we could see is a return of that, maybe not next year, but it's not out of the ordinary to expect that we may see a 5% or a cap rate in the 4% range in the next 4 to 5 years. And at that point, sure, you may make $100,000 based on the 5.75% cap rate. But if it goes down to 4.5, man, you're making a killing. And you can see how market appreciation plays into here. Of course, we always say that market appreciation is the icing on top of the cake. You want to be going into value add and producing good returns, regardless whether you have the market trade winds at your back. We've always been pretty notorious for going above and beyond and being more conservative than your most institutional operators. Most institutional operators, I see them being a little bit too aggressive, using a terminal cap rate of 0.5% under ours. You know, if we're underwriting for a 6% exit, they might be using a 5.5% exit. If you're a passive investor that's just not aware of this, I call this cap rate gate. It's just important that you understand this concept and you can see as you move up 0.5%, 0.25%, how that changes the projected returns very greatly.